Hello and welcome to another video. I'm Adi from Pixel Profits and this is video 12 in my market structure series. In this video, I'm going to explain why you need to understand what divergences are, how to find them, and how they can be a massive benefit to your trading. If you're second guessing yourself on whether a trade is about to go in the direction your other analysis tells you, I'm going to show you some different methods that you can use to get an extra and very strong indication on whether you're right or wrong. I'll show you how divergence can be used to identify changes in trend, reversal points, and pullbacks. I'll also show you how to use them to stay in a trend longer, maximising your profits. So let's get started by talking about what a divergence actually is. So a divergence is a situation where two things that were the same suddenly become different, or the difference between them increases. We can see some examples here on the screen. So here we can see a cheat sheet of different types of divergence, and don't worry if it looks confusing at first, I'm going to talk you all the way through it. So in video 10 in the series, we looked at the concept of a divergence between two assets. So you can go and check that out if you want to know more. But in this video, we're going to look at divergence between a single asset and an indicator. Now personally, I don't normally use many indicators, and when I do, it's usually for quality of life reasons or to see something very specific. But divergences between price and an indicator is one of the exceptions that I think is definitely worth having knowledge of and can definitely be included in your trading model if it's something that resonates with you. So let's dive deeper into it. Divergences between price and an indicator are normally found by using oscillator style indicators like the RSI, MACD, or in this case, the one we're going to use in this video is the Disparity Index. And that you can see here. And there are many other type of oscillator indicators, and each of those oscillators calculates its values based on its own unique formula. So different indicators give different results because they are calculated differently. And of course, you can further influence this by the settings that you choose within the indicator menu. So it's worth going out and testing to see which one fits best for you. And you can also use more than one at once, of course, if you want to get further confirmation or to ensure that you don't miss any divergences. So let's take a quick look at how to set up the Disparity Index. So in TradingView, you just go up to Indicators, you start typing Disparity Index, and you can see that it's this one here by Everget. This one actually here by Donovan Wall is also good, but this one I think is more simple and easy to get going with. So we add that to our chart and we end up with these indicators here. If you don't have TradingView, there's a link in the description if you want to follow along with this video. But otherwise, you can use any oscillator that your platform has. I'd recommend something like the RSI, for example. Now, what you're going to see is that with a lot of these oscillators, the results can be fairly similar. But there are a few differences, and I find that generally the Disparity Index is very good at picking up on divergence. But if you want to see a full video on the Disparity Index in the future, just let me know in the comments below. So let me just give you a quick summary then of what the Disparity Index actually does and why it's one of my favourites to use for tracking divergence and seeing the strength of the momentum in price. So the Disparity Index takes a moving average and compares price to that moving average. It then plots its oscillator, which shows a measurement of how far away price is currently from the moving average. Now I won't focus on the momentum side of things so much in this video, just the divergence. So if we double click on the oscillator here on the Disparity Index, you can see it's a very simple indicator. There isn't really much to it. All we're really interested in is going to be the length, which I set to 14, which is actually the default that the RSI goes to as well. Okay, so feel free to set the Disparity Index to 14. And I am currently on the 5-minute chart. Doesn't really matter. I just picked a time frame because if you've watched my market structure videos, you'll know the time frame doesn't really matter because it's all fractal and everything happens the same on every time frame. So if you want to play around with the settings, of course you can do that, but I've found 14 to be optimal for looking for divergence. But it's best to go and test things on your own, of course, depending on what you trade. All right, so now we're set up. Let's look at a quick bit of theory before we look at the real chart examples. The easiest way to visualize and remember the types of divergence is to use the cheat sheet that we saw earlier. And I'm going to put a download link for that in the comments below so you can just download that for free. Okay, so let's talk about what we expect from price and what we expect from an indicator. So we expect that most of the time the price and the indicator should move in fairly similar ways, creating the same sort of structure of, for example, here we can see there's a low put in and then there's a high put in on the indicator and the price. Okay, so a low and a high, a low and a high. So we're kind of expecting that they create the same kind of structure on both. And that indicates that they're both kind of following the same type of trend. But sometimes a divergence occurs, or in other words, they show something different from each other. Let's go back to the cheat sheet quickly. So here we can see, for example, that the price is making lower lows, but the indicator is making higher lows. Now, if you watch my SMT divergence video, this should look pretty familiar, as it's basically the same sort of structure that we're looking for here, but instead of looking between two assets, we're looking between the price and an indicator. So let's talk about what these divergences actually show. What they usually show is they signal strength or weakness in the momentum of price. So for example, if price is coming down and it seems to be, forcing price lower and lower, but the indicator starts to move higher suddenly, then it's showing that momentum is picking up. And it's not picking up the down direction, it's picking up to go up. So the momentum downwards is actually weakening. So using this means that you can accurately predict changes in trend in the form of either short-term pullbacks or full trend reversals. They can also be used to see when a trend is likely to continue in its current direction. So a lot of powerful stuff there. Let me show you. So here we have, basically, we're saying that these are strong, average and weak. Now, that's a bit subjective. Wouldn't worry too much about it, but you can see here the structure is slightly different, okay? But the main thing to consider is that the price and the indicator are doing something different. And we have bullish examples, and bullish examples can only happen at the bottom of price, underneath price. And bearish examples of divergence can only happen at the tops of price, at the highs, okay? So what we're looking at here, for example, on this bearish example, is that price is making higher highs, but the indicator is making lower highs. So price is coming up, and perhaps the uptrend is finishing, or we're going to get a pullback. So we're going to get some kind of move downwards now, and you can see the momentum is shifting downwards. Okay? And that's really how you have to think about it. Now here you can see that the price is flat on the top, so it's making basically equal highs, and the indicator is losing momentum. So again, it's a divergence, right? They're doing something different. Now, these are strong, average and weak. I don't put too much weight in that, because this average one here can be equally as strong as the supposed strong one. I wouldn't worry too much about that. It's just a way to sort of differentiate them a little bit. I wouldn't worry about these words here too much, okay? So we've got three, let's say, categories here of bullish and three categories of bearish, but they're all the same idea. These happen at the bottom of price, and the bearish examples happen at the top of price. And then down here we have something called hidden divergences. And while the regular divergence usually signals some kind of reversal or pullback, the hidden divergence usually shows that the trend, or the current trend that we're in, is going to continue. So for example, if you're getting worried that you're in a trade and you think, oh, you should probably get out of that trade because it's gone quite far in your favour, if you track hidden divergences, what you can often see is that you'll get a signal that the trend is potentially going to continue. And if you're seeing, for example, change in the state of deliveries, on the way down as well, backing that up, then you can put those two things together and say that, okay, maybe I should stay in this trade a little longer because it's going nicely in my favour. All depends on how you trade, your trading model, your risk parameters, all that sort of stuff. But you can use these continuations to understand, okay, the current trend is likely to continue. Now, if you study these in detail, you can see that, for example, the bullish version shows that the price, the lows of price are getting higher, but the indicator is still showing downwards momentum. Okay? And what this usually shows is that the bullish trend is going to continue. And we can see here the bearish example where price is making lower highs and the indicator is making higher highs. These are a little bit more difficult to understand at first, so I'll show you a chart example in a moment and it'll make it much more clear. Okay, so hopping over to the chart then, I've pre-marked some stuff out for us so it's easy for you guys to see. Let's just zoom in. Now, what I've mostly focused on is the NASDAQ here, but we'll come over to the S&P and look at a couple of things in a moment. So what I want you to notice first here is if you see the bigger structure, for a while there, we've been in a downtrend, right, in that day, okay? So we came up and then we started to flip to having a downtrend on the 5-minute chart. This is, okay? I don't want to put too many time frames in this because it will get too confusing. So let's just say, look, we're in a downtrend, okay? So if we want to see that continue, then we want to see a hidden bearish divergence. So if we remember, for a hidden bearish divergence, a continuation of the bearish trend, we want to see lower highs on the price and higher highs on the indicator. If I just drag that to the side, you can see right here with this red line that I've drawn. Let me just zoom that in a little bit so you can see a bit better. Pull that back up. So you can see here that we've got a high and a lower high, okay? And on the indicator, we've actually got a high and a higher high, okay? So we can see the red line on both of these drawn to exactly the same points. You've got a divergence, okay? And look where that divergence happens to happen, right inside a 5-minute IFVG. So when price has gone down and we're coming back up into this, if you get that divergence there, all you need to do is wait for a further confirmation, let's say a change in the state of delivery like here. You enter here, price comes up, tags you in, and falls right off and goes down. Okay, so then we move on to a bullish example then. So now we can see down here on these two lows, the price is sloping downwards, making a lower low, and it's actually swept, of course, this previous low. It's also inside a daily fair value gap. So when price on the oscillator, on the disparity index, starts to go upwards, we can see that we have a divergence. And we also have a very, very clean break here, change in the state of delivery, tap back in, and off we go. Okay, so a nice bullish version. Now, what you also have here is if you look at the S&P, or ES as we call it, you can see we actually have an SMT divergence. If you haven't seen my video on that, go watch it. And that's a divergence between what the S&P is doing and what the NASDAQ is doing. This one's made a lower low, this one's made a higher low. Okay, so we have a divergence there as well, an SMT divergence. So now we have an SMT divergence, and then NQ also has a divergence with the disparity index. It also has, if you see here, what we'd say is oversold on the RSI and a divergence. So you can see that the RSI is agreeing with the disparity index. The SMT is also agreeing. All these three divergences, if you like, are all saying that, yep, price is likely to go up. Once we get the change in state delivery, we could enter, get tagged back in, and off we go to the upside. Nice trade. Now, when we come up, this is something I want to show you that's important. So first off, I've drawn this dotted line here, this dashed line, okay? Because we have, let me just draw that a bit better. You can see here on the RSI still thinks we're going up, right? Which is good, okay? In this case, I'd say the RSI is more accurate in the sense of tracking price, but the disparity index is giving us an earlier warning that something might be coming up, so we can get ready. Now, how would we avoid, if we have a trade here, okay, if we thought this was a bearish example of a divergence, okay, you can see the oscillator and you can see the dotted or dashed line on NQ. If we thought this was a divergence and we were going to enter here, how would we prevent ourselves from getting into a trade too early? Well, first off, do we see any bearish change in the state of delivery in this section of price here? No. If you've got this range of up-close candles that need to get closed below to cause a change in the state of delivery, nothing from this area here indicates that. It hasn't happened. Okay, there's no close below any of these up close candles. Now, when we start to come up further, we're going to be holding now. We're going to be waiting, expecting something might happen, but we're not going to be executing yet. Okay, because look what we have here. We have these relatively equal highs over here, and what happens? Price comes up, sweeps them. That's this dashed line here. Sweeps those previous relative equal highs, and then we start to get the rejection. Okay, so now we have change in the state of deliveries, because we have this bullish candle right here that gets closed below. So we have a change in the state of delivery there. We have a sweep of the highs, if we wanted to wait for that too, because we know from my liquidity video that relatively equal highs often get swept. We can see that here. So if we'd entered on this change in state of delivery, we'd probably be okay. But if we wait a little bit and see that price is coming so close to these relatively equal highs, it's probably going to take them. Okay, so we wait, and then what do we get? Look, we get another divergence, this solid red line this time. We get a lower high and a higher high, and on the indicator it starts to fall off in the momentum. We get lower highs. Okay, so once we see this plus the sweep plus the change in the state delivery, that's when we want to enter. Now, what we also have, if you see this black line here that I've drawn on ES, I've actually drawn, let me try and show you that. I'll take away this one for now just to get it out of the way. Oh, sorry. There. Okay. So you can see the black line is actually an SMT with ES. Okay. So now we've got change in state of delivery, SMT. We have a fall off in momentum in the disparity index. We also have the regular bearish divergence happening. Now we've got a ton of stuff, a ton of reasons to potentially enter a trade here. And if we did with a stop on the high, as you can see, and now I don't know actually, because this morning, yeah, okay, there we go. I drew this out this morning and this hadn't happened yet. But look, there we go, there's your 3 to 1. Okay, as you can see, price is now coming back up a little, but just a slow, gradual fall off until we hit the profit. Now, I didn't know this was going to go to take profit, actually, so that was news to me because I'd just seen it. But I drew this out. I don't know where we were this morning. Where were we when I woke up? Somewhere in here, I think, somewhere in this area. So I considered that after this, there's a good chance we're going to come down. I should have taken that trade, shouldn't I? But I was busy with other things, making videos and stuff. Anyway, so there's an example of a regular bearish divergence. So then we have that regular bullish divergence that we had down here. And we have the hidden bearish divergence showing that the trend is likely to continue to the downside. Okay, and as we can see, that's what happened. We got a big drop off here, and then we continued downwards here. Maybe there's some other bearish ones in here and stuff as well, but I don't want to go into too many examples, get too complicated. I think that's an example of all the different types, and that's all we really need. It doesn't really need to be more complicated than that. So now that we've seen all these different types of divergence in action, all we really need to do, as we've just done in this video, is add in other concepts from the series of videos that I've made, the market structure series. So we could add in, fair value gaps, changing the state of deliveries, market structure, dip zones, like anything you want, basically. Higher time frames, obviously. As always, the more confluence that you have, the better indication that these divergences are going to work. And basically, you could use these indicator divergences with price in exactly the same way, really, as we use SMT divergences from the previous video. And again, it's from that perspective that we need more confluences to consider taking a trade than just seeing a divergence, right? Now, the one thing that is different, really, between SMT and between these type of divergences, indicator divergences, is that SMT is used for a change in price direction, whereas an indicator divergence can be used to also identify when a continuation might happen. So indicator divergence has an extra use that SMT won't be able to show you. And if you want, you can experiment with both together, as we just did in the video. As I keep saying, you should in the end be able to take select tools from this series and combine them together to form your own trading model. You just need to take the things that resonate the most with you and start experimenting with ways that you can put them together to form your own model. But essentially, that's the basics of indicator divergence in trading. So go and look back in your charts or at the examples in this video and backtest this for yourself. As always, it's best to have multiple reasons or confluences to be taking a trade rather than a single one. But as we've seen, divergence can be a quite powerful tool. Now don't forget that the indicator you use, their settings, the assets you trade, the time frame you look at, and many other factors can have an influence on how many divergences you see, their quality, and their reliability. So you need to do some experimentation. And lastly, if you have any questions, just let me know in the comments below. And if you use divergences in your trading, let us know how, when, where, and why. If you like this video, press that button and also subscribe to the channel and hit the notification bell as always. Also consider sharing the video with a friend who might find it useful. Appreciate your time, guys. Take care, and thanks for watching.